in most of my interviews where there was some kind of commercial case study, financing acquisition is something that came up. It's good to start by having a broader discussion about how methods of financing will change depending on the stage a business has reached. So if you're a startup and you're just starting out, maybe you'll start by financing your business using your savings. Maybe you'll ask family members for small loans, or you'll ask family members to invest for a small ownership stake in your business. You might use an overdraft and credit cards and all that kind of thing. I used money from my student loan to initially finance City Career Series, and then I managed to sell certain products in advance, and that helped me to then fund the printing of those products. And it was a very different method of financing to what some kind of large multinational company would use. Now, as a business then starts to grow and it becomes maybe a scale up, which is a startup that's started to grow, that's where they might look to take on larger investments from angel investors, who are just high net worth individuals who look to invest in companies, and they tend to offer mentorship and introductions and advice to then help those companies grow. If you need more money than angel investors can offer, then you might look at raising investment through venture capital firms. If you're already generating revenue and you're confident you can repay a loan, then maybe you'll look at larger business loans. And then as you become a much more established, mature company, that's where you might look at syndicated loans, which are essentially loans provided by a collection of lenders. For example, if you need to borrow 500 million, there might not be any lender in the market willing to take that kind of risk. But a lender might say, look, I'm willing to lend you 50 million, and I'm willing to club together with 9 other lenders also willing to lend you 50 million. So combined, we will lend you 500 million, and that pool of lenders will then share the risks and share the rewards. That's kind of how a syndicated loan works. So a large corporate might look for a syndicated loan, or they might look to sell bonds through the capital markets, or list their shares on a stock exchange and sell equity to sort of the public at large. So that's how methods of financing might change depending on the stage the company has reached. So if we look at these different methods of financing and try and figure out some of the pros and cons, that's the kind of critical analysis and discussion you might have in an interview. So starting off with cash reserves, if you're using money that you've saved up to set up your startup, or if you're a large company, you've got millions in the bank and you're going to use that money to finance some kind of expansion or acquisition, it can be good because you're not giving away any ownership in the company. Unlike a loan, you don't have an obligation to repay anyone because you're using your own money. It can be quicker to arrange, much cheaper to access because you're just accessing money that's already yours. There's not that negotiation element. However, if it's some kind of big acquisition or you're a really small company, it's unlikely you'll have enough cash in reserves to use for that. And you might not want to use all the cash you've got because you might need some of that cash just to protect your financial position and make sure you've got some kind of cushion. Then with things like overdrafts, credit cards, loans, I mean, all of these are forms of debt. They can be good in the sense that you're not giving away ownership. So if you take out a loan and you use that money to make your business grow exponentially, you're not then thinking, I wish I hadn't given away 5% of my business to access that money because that 5% is now worth an absolute fortune. You've not given away any ownership. Debt can be tax efficient in the sense that if a company is paying interest on a loan, those interest payments can then be offset against its profits, which reduces its, almost like it's a business expense. This then reduces its overall profit figure, which means it will pay less corporate tax. That's an oversimplification, by the way, but there are tax efficiencies there. But with debt, there is this obligation to repay. And if you can't repay, that's where you can end up losing your business because the lender takes it over or files to make your business go into insolvency or something like that. So the risk with a loan is if you don't generate enough revenue to pay back that loan, that's when you can be in real trouble. Also, especially for larger loans, lenders will usually ask for something that's known as security. Security is a right to seize some of your assets, perhaps take control of those assets and sell those assets, and then use the money from the sale to repay any money that you owe the lender, but you failed to repay that lender. And that's something that you obviously don't want to happen to your business. So that's a real risk. And usually with that kind of debt finance, especially when there's a lot more money involved, that's when security could be essential if you want to borrow that kind of money. Also, if you do offer a lender security over one of your assets, let's say your stock or a factory, the terms of that security might be quite restrictive. So the lender will say, right, I want security over these assets. And whilst that security exists, i.e. before you've paid us back in full, you can't do anything with that asset without our permission. You can't sell it, you can't build on top of it, you can't do anything without us consenting. So that's how it can be restrictive. Now, moving on to bonds. Bonds are another form of debt. Now, to explain what a bond is, I'll give a basic example. So let's say I've got a piece of paper here, bond written on it. I'm a company, I want to raise a load of money. So I have all these pieces of paper called bonds. And bonds used to be pieces of paper, but now it's all electronic. Now I could sell, let's say I've got 10,000 of these pieces of paper. I could sell each piece of paper, and I say each piece of paper costs £100, sell it through the capital markets, and anyone and everyone pretty much can buy these pieces of paper from me. So I give them a piece of paper, they give me £100 in return. Hopefully you're with me so far. Now what that piece of paper that I have now sold to someone else will entitle that person to is a few years down the line, maybe 10 years down the line, they'll be entitled to a lump sum payment of exactly what they invested right now. So they're gonna get their money back as long as I don't go insolvent in 10 years time. So in that sense, the bond is a bit like an IOU. And you're probably thinking, well, why would they do that? Why would they take the risk if they're only getting their money back? Where they make money from buying a bond is on top of me giving them all their money back right at the end, every year or every half year or whatever's agreed, I will pay them a certain amount of money. It's called a coupon. It's usually a percentage of their initial investment. So I might say, buy this piece of paper from me for £100, and every year I will pay you 10% of that. So I'll give you 10 quid every year. And then at the end of a 10-year period, I will also give you a lump sum of £100. So the investor that bought the bond has essentially doubled their money by the end of the 10 years. And I've managed to get £100 up front to finance the expansion of my business. With a bond, you're not giving away ownership because it's a form of debt. If your company is well known and people want to buy the bonds, you can raise a huge amount of money because technically anyone can buy a bond through a stock exchange or a capital markets exchange, which means you're accessing potentially tens of thousands of investors, if not more. Now the problem is if no one knows who your company is, or your company's not doing very well, it's not got much profile, there might not be any demand for those bonds. So it's all well and good saying, I've got all these bonds for sale. There's no guarantee you're going to get the money. Now, investment banks, as part of their offering, might say to a company, look, if you don't manage to sell all your bonds once we launch this bond issue, we will buy up any unsold bonds. So we're going to guarantee you that either way you'll get the money. And that's known as underwriting. But in general, if I wanted to raise money for City Career Series, there's no way I could launch a bond because people just won't know what the company is, and there wouldn't be that demand there. As I mentioned, it can be costly to arrange because there's loads of admin to do, and you do have that obligation to repay. You've got that obligation to repay the kind of smaller percentage every year, that what's known as a coupon payment. And then you've got to make sure that when the bond kind of period matures, or it's known as when the bond matures, but when that period ends, maybe 10 years down the line, you've got to make sure you've got enough money to repay all the people in full who bought your bonds previously. So that's where the risk kind of comes in. So you've got this issue, you've got this option with a bond if you don't want to give away ownership. And then another option is equity funding. So I already mentioned that you can kind of sell a part ownership stake in your business to maybe family members, and then angel investors, and venture capital, and maybe private equity. If you want to raise a huge amount of money through selling shares, that's where companies might IPO. And IPO stands for initial public offering. And the word initial is a really important word there, and try not to get mixed up in an interview. An initial public offering refers to the first time that a company lists and sells its shares through a stock exchange. It's the first time. If a company sells its shares through a stock exchange every year, the second, third, fourth, fifth time, those are not IPOs. Those are just share sales. It might be known as a rights issue. So an IPO is the first time a business lists and sells its shares through a stock exchange. Now, with that, you're giving away a load of control, but in return, you might be able to raise a huge amount of money. You don't usually have an obligation to pay dividends. So that means, unlike with a loan or a bond, you don't have this fixed obligation to repay. You don't have to offer security because people are buying a controlling stake or a small stake in your business. But the main thing is you are giving away ownership. And if you give away a lot of ownership to individual parties, then you might be giving away a load of control. Now, if you're selling shares on a much smaller scale to some kind of high net worth individual, you might also benefit from that individual's mentorship and knowledge and all that kind of stuff. But if you're selling shares through a stock exchange to what feels like anonymous investors all over the country, then you might not have that same kind of benefit.